So in this video, I'm going to cover PE ratio, price to earnings per share, or more commonly referred to as price multiple and earnings multiple. And we're going to talk about how it works in the real world, how I personally use it to evaluate stocks. All right, so right off the bat, I want to talk about a common misconception of the PE ratio, which is the most popular metric for valuing how cheap or expensive a stock price is relative to its competitors. That being said, PE, commonly people refer to as price over earnings, but it's actually the share price over earnings per share. So it's EPS. It's not earnings, it's earnings per share. So simply and mathematically, it is the current price per share divided by the earnings per share. So the question then becomes, how do we calculate earnings per share? And people often think maybe it's last quarter, maybe it's the last 2 quarters. If nothing else is specified, when you see PE ratio, so for instance, if we go to Intel here and we take a look at their PE, we'll see that it's 9.61. And since there's no other qualifiers to let us know what type of PE, when you see PE, it is typically calculated by dividing a company's stock price by its earnings per share from the most recent fiscal year. When people refer to the PE ratio, typically they're referring to trailing PE because it is calculated by dividing the current price by the earnings per share over the past 12 months. And as we can take a look here, Intel's PE is 9.61. Advanced Micro Devices, which is its competitor, is 48.11. And so when using PE, you want to be comparing it to another company in the same sector. Because as you'll see here, if we take a look at Tesla's PE, it's 368.97. Doesn't really help us when comparing with Intel and AMD because they have different business models. They have different types of revenue streams. And so we have to be careful about comparing apples to apples, not apples to oranges. So we can use PE to compare Ford stock to GM stock or Intel stock to AMD stock. When using PE ratio, stick to the same sector to make sure PE analysis is most effective. So as we see here for Intel, the PE ratio is 9.61, and for AMD, it is 48.11. So you might think, wow, AMD is way overpriced. However, there can be a reason for it. A very high PE ratio could mean that the underlying company is overvalued at the moment, but it can also mean that investors are expecting rapid high growth rates in the future, which would bring the PE value down with time. So for instance, AMD, its chips are amazing. Intel has had some major delays and its recent chips are not competitive to AMD's top-of-the-line chips. So people are okay at purchasing AMD at around $155 today with a PE ratio of 48.11 because they're so confident that over time, AMD is actually going to continue increasing their earnings per share. So basically, PE answers the question of how much money investors are willing to pay today for a certain stock relative to the earnings per share. So when you're researching a stock, you will typically see, if you're just using a simple dashboard, you'll see some general information like the year range price, the market cap, the volume, but you'll also see PE ratio. And for a lot of stocks, they simply have a dash or null. There's nothing showing up for PE ratio. Why? Well, if there is no PE ratio for a company, it simply means that the company is not profitable, and so it has zero earnings. And since zero cannot exist in the denominator, because remember, share price over earnings per share is how you calculate it, since this part cannot be zero, the price to earnings per share is undefined or not listed. And that's all this means. The company is not yet profitable. As we can see here with Tesla, although the PE ratio is a very helpful metric when analyzing a stock, it does not paint the big picture and should be used with other metrics, analysis, research, etc. when making investment decisions. Because if we go ahead and we look at Tesla, PE ratio of 368.97, and the PE ratio of Ford, which has a PE ratio of 27.51, even though Ford is going to be competing with Tesla, they're putting a lot of their new line of cars as electric vehicles. They're betting big on themselves as an EV player in the coming years. That being said, Tesla's PE ratio makes absolutely no sense. It's 368, right? but you could possibly be using something like forward PE to get a better metric for Tesla, and I'm going to cover that in a separate video. But why do people buy low PE value stocks? For instance, Ford was just recently under 10 PE ratio. Why is that? Typically, it's because investors see them as undervalued and believe that the future projections for growth are being undervalued. However, there are times that investors buy high PE stocks because they feel the company will actually outpace the predicted growth and the PE will look more appealing down the line. When a stock is growing at a very high clip as far as revenue, earnings, expansion, etc., investors typically tolerate a higher PE ratio, and we could see this with Tesla. People are tolerating a 368.97 PE ratio, and I believe this PE ratio was above 750 just very recently, and the reason it went down is because Tesla reported great earnings, which factored into their earnings per share, which means that their denominator became larger, and that means that the PE is going to be smaller. Now with Ford, in the past year, it has actually worked out to buy them at a low PE, because now better news is coming out about Ford. There's a lot of projections that Ford will be doing well, and so people ran up the stock to a price where the PE ratio is now 27.51 instead of hovering around 10. That being said, you can't just go by PE ratio. That will be something called a value trap. And a value trap occurs when folks buy companies with a low PE ratio because they assume it's a good bargain, whereas the reason for the low multiple is actually that they are experiencing financial instability and they have little future growth potential. For instance, BlackBerry used to be very profitable, and then they ran into a lot of trouble. And at some point, they were trading at a great PE ratio, very, very low. However, we all know how that worked out for them. Now, something else I want to mention is that when there's a market correction, so when investors go and they take money out of certain sectors because the market is crashing, because of fear, uncertainty, doubt, whatever it may be, when there's a broader market sell-off, usually the stocks that have a lower PE ratio, so for instance, Intel and AMD, which has a higher one, Intel has a lower PE ratio, typically the stocks with the lower PE ratio, they're the ones that get hurt the least. So not a lot of capital outflow from the low PE ratio stocks because they're kind of trading on basement floor prices anyways. Whereas AMD, it is trading at a lofty PE of 48.11. And so it tends to drop more percentage-wise than something like Intel when there's a broader market sell-off. At least that's what I've found in my findings. If you disagree, please mention in the comments. And now, before I cap off the video, I want to talk about historical PE ratios for the US stock market, because even though I mentioned that a lot of people, they use PE to compare stocks in the same sector, sometimes people use the PE ratio to compare it to the average PE ratio in the S&P 500 index. And since 1900, the average PE ratio for the S&P 500 index has ranged from 4.78 in December of 1920 to 44.2 in December of 1999. Today, it's very rare to see a PE value of 4.78. Does this mean that we're taking on more risk and we're willing to park capital because of fears of inflation and the dollar going down, that we would rather pay at a higher multiple, but at least have our money invested in something? It's a good question, and we will see how that works out. However, except for some brief periods, during 1920 to 1990, the market PE ratio was mostly between 10 and 20, and that kind of largely is the case for a lot of sectors. A lot of companies that have already matured and are just paying dividends, they typically have a PE ratio between 10 and 20. Companies that can aggressively expand and people may think that they may grow very rapidly, they're okay paying for a high multiple, and the companies that they think are going to be flat for the next decade, they're okay paying a very, very, very low multiple. They're not okay paying a high multiple. The average PE of the market varies in relation, among other factors, expected growth of earnings, expected stability of earnings, expected inflation, and yields of competing investments. For example, when U.S. Treasury bonds yield high returns, investors pay less for a given earnings per share and PEs fall. And so hopefully this clears it up and makes it a little bit more simpler to understand PE ratio. If you don't quite get it, feel free to watch the video a couple of times. Me personally, I always go over and over content until it resonates and I understand it. Some terms in investing, they can really be intimidating at first, but once you figure out exactly what it is, it all makes sense, and then you can be a better investor, you could do better analysis, and just become a better investor all around. So I hope this video helps. If you liked it, please leave a comment in the comment section, and I'll see you guys in the next video.